In the late 90s, everyone was piling into the internet companies. The stock market was booming and it felt like free money was available. Then in 2000, it imploded. Companies that were worth billions became worthless almost overnight, and an estimated 100 million everyday investors lost $5 trillion. Now people are worried that AI could be the next bubble, and if they're right, Muslim investors could be hit the hardest. But most of us don't even realize it. In this video, I'm going to break down why and exactly what every Muslim investor should be doing right now to prepare. So let's start with what's actually driving all of this. Over the past few years, the stock market has been on an absolute tear, and almost all of it has been driven by a handful of companies, the Magnificent Seven as they are known: Microsoft, Apple, Nvidia, Amazon, Meta, Alphabet, and Tesla, all making big bets on AI. Now, share prices are going up, and that in itself isn't a problem. What makes people nervous is the valuation. Take Nvidia. It's now one of the largest companies in the entire world, and investors are giving it a price to earnings ratio of around 50. That means at current earnings, it would take 50 years of profits to earn back what you paid for the stock today. That's an enormous amount of faith in future growth. And look, that faith might be justified. These companies are genuinely transforming industries. But history tells us that when the story gets ahead of the fundamentals, eventually something snaps. We're not saying it will, but it's worth asking, what's the most fragile part of this whole thing? What's the single point of failure? Because there is one. Most people think that Nvidia makes AI chips, but that's not quite accurate. Nvidia designs chips. The company that actually manufactures them, along with Apple's chips and pretty much every other cutting-edge processor you can name, is one company, and that's called TSMC, Taiwan Semiconductor Manufacturing Company. In 2025, TSMC held nearly 70% of the global foundry market. Its nearest competitor sat at just 7%, and their chips are just not that good. This isn't market dominance, it's near total control of the most critical technology in the world right now. And TSMC is based where? Taiwan, an island that China considers its own territory. And if you zoom out for a second, the world right now is not a stable place. Russia and Ukraine are still at war. Iran and Israel have been exchanging strikes. The US is stretched across multiple flashpoints simultaneously across the world. We are living in a period of genuine geopolitical instability in a way we haven't seen in decades. So there's a very real chance that something could happen that disrupts TSMC. Indeed, we are seeing early signs of that right now with the Strait of Hormuz being closed. Because guess what? One of the things that TSMC needs is the gases and the heliums that are coming out of gas and oil production that happens in Qatar, the UAE, and Saudi Arabia. But you might say, couldn't Nvidia just use another manufacturer if something happens to TSMC? Unfortunately, it's not that simple. This is almost impossible. The chips powering modern AI can only be manufactured by two companies in the world: TSMC and Samsung. Samsung is theoretically the backup, but Nvidia actually tried them during the pandemic and went straight back to TSMC because the defect rates of the chips were too high. And by the way, TSMC are building new factories in Arizona as well, but the project is already years behind schedule, and building the talent and the supply chains that is needed is a decades-long project at a minimum. This is truly cutting-edge stuff, and there simply isn't a feasible plan B today. So if something happens in Taiwan, the entire AI industry is in serious trouble. And this is the bit that nobody is talking about. Most conventional investors have a naturally diversified portfolio. They've got the S&P 500, which spreads your money across 500 plus companies spanning every major sector of the US economy. And on top of that, many will have exposure to bonds to add diversification. Now, as Muslims, we can't just invest in anything. We have sharia screening, which means we exclude companies involved in haram activities: conventional banking, alcohol, gambling, tobacco, weapons. They're all out. And what that means in practice is that our version of the S&P 500 looks very different to everyone else's. A standard S&P 500 ETF has around 35% allocated to tech, but the most popular halal alternative, SPUS, sits at around 55% tech exposure. Because once you strip out all of those haram industries, what is left is largely tech. And within that, SPUS's three biggest holdings alone, Apple, Nvidia, and Microsoft, make up around 37% of the entire fund. And also, yes, Nvidia, the company sitting right at the center of everything we just talked about. Now, to be fair, this concentration has actually worked in our favor recently. These ETFs have outperformed the S&P 500 over the past few years, largely because tech has done so well. But that sword cuts both ways. If tech crashes, and it will at some point, then so will your portfolio. Now compare that to a conventional investor who can spread their money across banks, insurance, defense contractors, bonds, all sectors that we can't touch. And if tech takes a hit, those other sectors typically cushion the blow for these investors. And yes, we do also have sukuk as a halal alternative to bonds, but let's be honest, most Muslim investors aren't holding them. We're mainly just in stocks. So when stocks fall, there's very little else in our portfolio to soften the blow. Now you might be thinking, I'm not really that exposed to stocks, but if you have a pension or a workplace retirement account, you're almost certainly exposed to these stocks. By default, most of those are heavily invested in equities. So this affects more of us than we realize, and disproportionately so for Muslims. So if the AI bubble does burst or something happens in Taiwan, Muslim investors will feel it harder and faster than most. So let's get practical. There are really just two things to take away from this video. The first is to acknowledge the concentration risk. Most Muslim investors have never looked at their halal ETF and thought, over half of this is in tech. Over a third of it is in 3 companies. Now you know that. That's not a reason to panic or sell everything, but it is a reason to be intentional. You might be watching this thinking, actually, I'm comfortable being heavily in tech. I believe in the AI story and I'm willing to ride it out even if there are some bumps. And that's a valid position. But there will be a lot of you watching this who have just realized that their portfolio is more exposed than they thought and are wondering, what can we actually do about it? Which brings us to the second point, diversification. It's not the first time I've said this, but let's be specific about what exactly this means. Because diversification isn't just buying a different halal ETF. True diversification means holding assets that are uncorrelated. What that means in plain English is that assets that don't fall at the same time for the same reason. If everything in your portfolio goes up and down together, you're all not really diversified at all. You're just spread across the same risk. So what does that actually look like? Gold and silver are classic examples. When markets are turbulent, investors are nervous. Gold tends to hold its value or even go up. It zigs when stocks zag. That's exactly what you want. Then there's property. Most Muslims already have a love affair with property, and for good reason. But here's something a lot of people don't realize. You don't have to wait until you've saved a full deposit to get exposure to property. There are now platforms where you can invest in as little as £100 and get yourself some property. Our own GBP Income Fund gives you pooled exposure to property-backed financing as we fund halal home finance providers such as StrideUp and Offer and others, helping Muslims get onto the property ladder. And you can get started from as little as £5,000. And then there are businesses outside the stock market entirely, on the early stage side where you've got startup investing, high risk, high potential reward. And then there's private equity where you're investing in established, profitable, traditional businesses that are looking to grow as well. And they're not big enough or prominent enough to be in the stock market yet. We have our own halal private equity strategy where we've been investing in a chain of pharmacies across the north of England. Real businesses generating over £30 million in annual revenue, completely uncorrelated to what's happening in the Nasdaq, which you can learn more about in this video here. But the point is simple. Spread your eggs across different baskets, not just different stocks, different types of assets all together, different geographies all together, so that no single event, whether that's an AI bubble or a crisis in Taiwan or the Middle East conflict, can wipe out everything you've built or put everything that you've built under some stress. And look, if you need help building a diversified portfolio, you can download our free halal investment checklist via the link below. It's in the description. And let me know in the comments how you found this video, whether you agree or disagree, and how you're feeling about your current portfolio after watching this. And hopefully we can make some videos to answer some of your questions as well. Until next time, Assalamu alaikum.